Here is the number that should grab every household in Britain this morning. The average 2-year fixed mortgage in the UK is still hovering well above where it sat before the cost of living shock, and millions of fixed deals signed in cheaper years are still rolling onto far higher rates through 2026. That single shift quietly reshapes household budgets up and down the country. Welcome to your UK financial update for Monday the 15th of June 2026. In the next few minutes we will walk through where interest rates stand, what is happening with inflation, how the FTSE and the pound are behaving, and the data landing this week that could move your savings, your mortgage, and your investments. No hype, no jargon, just the numbers that actually touch your money. The single biggest lever over your finances right now is the Bank of England's base rate, set by its 9-member Monetary Policy Committee. After the most aggressive tightening cycle in decades, the bank has spent recent meetings carefully weighing how fast it can cut without reigniting inflation. The committee meets roughly every 6 weeks and votes are published alongside detailed minutes, so markets scrutinize not just the decision but the split of the vote. A unanimous hold signals caution, a divided vote with dissenters pushing for cuts signals change is coming. For anyone with a tracker mortgage or a variable savings account, every quarter-point move feeds through almost immediately, which is why the base rate dominates the financial headlines. Inflation is the story underneath every rate decision. The Office for National Statistics publishes the Consumer Prices Index monthly, and the bank's official target remains 2%. Getting there has been a grind. The headline rate fell sharply from its painful double-digit peak, but so-called sticky components, particularly services inflation and wage growth, have proved stubborn. Policymakers watch core inflation, which strips out volatile food and energy, because it reveals the underlying trend. The practical takeaway is simple. When inflation cools steadily, the door opens to rate cuts, cheaper borrowing, and a lift for mortgage holders. When it surprises on the upside, the bank stays cautious and your borrowing costs stay higher for longer. Turning to the markets, the FTSE 100 remains the headline barometer for British large-cap shares. Its character is distinctive. It is heavily weighted towards energy giants, banks, miners, and global consumer brands, and around 3/4 of its earnings come from overseas. That makes it surprisingly sensitive to the pound. When sterling falls, those foreign earnings translate into more pounds, which can actually lift the index. The more domestically focused FTSE 250 is often the better thermometer for the health of the UK economy itself. For everyday investors, the lesson is to look past the single headline figure and ask what is driving it, whether it is oil prices, banking results, or currency moves. The pound sterling sits at the crossroads of all of this. Its value against the US dollar and the euro reflects the gap between UK and overseas interest rates, the strength of our economy, and global risk appetite. A stronger pound makes your foreign holidays and imported goods cheaper, but squeezes exporters and those overseas FTSE earnings. Currency markets are also buffeted by events well beyond our shores, from US Federal Reserve policy to energy prices and geopolitical tension. That is why a quiet day in Westminster can still bring a volatile day for sterling. Keep an eye on the dollar rate in particular, as it feeds directly into the cost of fuel and many everyday imported goods. Let us bring this home to your wallet. On mortgages, fixed rates are priced off swap markets, which move on expectations of future bank rate decisions rather than today's rate alone. So fixes can fall even before the bank cuts, if markets sense easing ahead. If your deal expires this year, it is worth lining up an offer early, as many lenders let you secure a rate months in advance. On savings, the flip side of higher rates has been the best returns in years, but the top easy access and fixed bond deals move quickly and the headline accounts are often pulled within days. Loyalty rarely pays here. Switching to a market-leading account can add meaningful interest with minimal effort. So what should you actually watch this week? The UK financial calendar is driven by a predictable rhythm of releases. Inflation figures from the Office for National Statistics are the marquee event, followed closely by the labor market report covering unemployment, wage growth, and job vacancies. Retail sales data offers a read on whether households are spending or retrenching, while GDP figures confirm whether the economy is genuinely growing. Each of these can shift expectations for the next rate decision within minutes of publication. Alongside the homegrown data, keep half an eye on the U.S. inflation prints and Federal Reserve commentary, because what happens in Washington routinely ripples straight through to London markets and the pound. Let us pull the threads together. The direction of travel for British finances in mid-2026 hinges on one question: how quickly inflation settles back towards that 2% target. The answer dictates when borrowing gets cheaper, how generous savings stay, and how markets and the pound behave. The practical playbook is straightforward. Review your mortgage well before it expires, make your cash work in a top-paying account rather than a forgotten one, and treat short-term market noise with calm rather than panic. Information is your strongest financial tool, so stay informed and make decisions on facts, not fear. That is your UK financial update for the 15th of June. Look after your money, and we will see you in the next update.